Welcome to all of you. I have discussed with you equity security. Equity securities, equity securities represent ownership interests held by the shareholders in company. In other words, it is an investment in an organization, equity stock, to become a shareholder of the organization. The difference between holders of the equity security and holders of debt security is that the firm is not entitled to a regular payment, but they can profit from capital gain by selling the stock. Another difference is the equity security provide ownership right to the holder so that he become one of the owner of company. Owning stake proportion to the number of acquired shares. You have seen there the two parts. Number one, equity security. Number two, debt securities. Difference between equity security and debt security. Equity security, left side equity security differences, and right side debt security. Equity security have ownership of owner of the company. Debt security only creditor of the company. Next one, get dividend only when company earn sufficient profit. If company earn profit, then equity security holder receive dividend. Otherwise, none. Uh, Debt securities provides steady income to the investor. They are just like a investor. They getting interest. Equity security holder have a voting rights, but debt security holder not a voting rights. Next one, equity security is a unsecured money security. Debt security is the secured in a nature. And last one, equity security, share capital of the company. This is called share capital. Uh, you have seen the balance sheet, left side, we have written the capital. Debt security is the borrowed capital of the company. This is just like a loan. There are some differences there. Next one, third is the derivative security. Next one, you have seen derivative securities. Derivative securities are the financial instrument whose value depends on basic variables. The variable can be assets such as stocks, bonds, currencies, interest rate, market in indies, and goods. The main purpose of using derivative is to consider and minimize risk. It is achieved by ensuring against price movement, creating favorable conditions for the speculation, and getting access to hard to reach assets or markets. Formerly, derivatives were used to ensure balanced exchange rate for goods traded intermediated internationally. International traders needed in accounting system to lock their different national currencies at a specific exchange rates. There are four main types of the derivative securities. You have seen there the four type of the derivative securities. Number one, future. Number two, forwards. Number three, options. Number four, swap. Future, future also called future contract, are an agreement between two parties for the purchase and delivery of an asset and an agreed upon price at a future date. Future are traded on an exchange with the contractual already standardized in a future transaction. The parties involved must buy or sell the underlying assets. Next one, forwards. Forwards or forwarded contract are similar to future but do not trade on an exchange, only retailing when creating a forward contractual. The buyer and seller must determine the term, size, and settlement process of the derivatives. Another difference from future is the risk for both seller and buyers. The risk arises when one party becomes bankrupt and the other party may not able to protect its right end. As a result, losses the value of its position. Third one is option. Options or option contract are similar to the future contract as it is involve the purchase or sale of an asset between two parties at a predetermined date in the future for a specific price. The key difference between the two types of contract is that with an option, the buyer is not required to complete the action of buying or selling. And last one is swap. Swap in swap involve in exchange of one kind of cash flow with the others. For example, an interest rate swap enable a trader to switch to a variable interest rate loan from a fixed interest rate loan or vice versa. Hybrid security, and last one, fourth category is the hybrid security. Hybrid security, as the name suggests, is a type of security that combine characteristics of the both debt and equity securities. Money bankers and organizations turn to hybrid security to borrow money from investors. Similar to the bond, they typically promise to pay a higher interest at a fixed or floating rate until a certain time in the future. Unlike a bond, the number and timing of interest payment are not guaranteed. They can even be converted into shares or an investment can be terminated at any time. Next one, the example of the hybrid security. Example of hybrid security are preferred stock that enable a holder to receive dividend prior to the holders of common stock, convertible bonds that can be converted into a known amount of equity stock during the life of the bond or at maturity date, depending on the term of the contract extra. Hybrid security are the complex products. Even experienced investor may struggle to understand and evaluate the risk involved in a trading them. Institutional investors sometimes fail or understanding the term of the deal they enter into the while buying hybrid securities. This is the example. Next one, you have seen there the risk and return profile for the different securities. I have discussed with you four types of the securities, and uh, here is the a diagram, horizontal and vertical lines. You have seen there one line Risk, horizontal lines show risk and vertical lines show returns. You have seen bank deposit, lowest risk and lowest return. Public sector bonds, some risk and some returns. Cooperative bonds, uh, more risk or more return. Mutual fund, high risk and high return. And equity, high risk and high return. Last one, venture funds, highest risk and highest return. You have seen the diagram. Next one, key features of the security. Number one, transferability and negotiability. Securities can be easily transferred from one owner to another, facilitating a liquid market where they can be bought and sell quickly. Next one, ownership rights and obligations. Different type of securities have varying ownership rights and obligation. For example, equity securities like stocks provides shareholders with the voting rights, while debt security like bonds represent a loan with the interest payment. Third one is the potential for the profit and loss. Securities value can fluctuate, offering the potential for profit or loss depending on market conditions. Another one, fourth one, the diversification. Securities can be used to diversify investment portfolios, potentially mitigate getting risk and enhancing returns. Number five, income generation. Some securities like bond provide a regular income stream through interest payments, while other like stocks can generate income through dividends. Next one, liquidity. Securities listed on exchange are generally liquid, meaning they can be easily bought or sold, allowing investor to convert them into cash quickly. Another one, 7. Capital accessibility. Security market allow companies to raise capital efficiently, which can drive economic growth and innovation. Next one, different types. Security are the broadly classified into equity, debt, derivative securities, and last one, hybrid securities. Another one, risk. Security involve various risks including credit risk, the risk of default, market risk, fluctuation in a value, and interest rate risk, changing in interest rate impacting bond value. Next one, regulatory framework. Regulatory framework means the regulatory body. Number one, number A, the SEBI Act 1992, which empowering SEBI with the statutory power for number one, promoting the interests of investor in a securities. Number two, promoting development of the securities market, and another one, regulating the security market. Point number B, the Companies Act 2013, which provides regulation for the issuance, allotment, and transfer of security and related matters in a public issue of security. Next one, the Security Contract, yeah, Regulation Act 1956, which provides for the recognition and regulation of transaction in a security in stock exchange. Point number D, the Depository Act 1996, which provides for the electronic maintenance, and transfer of ownership of demat shares. You have seen the types of securities and features of securities. And last one, conclusion. Conclusion is security are the backbone of the modern financial system, enabling capital formulation, risk management, and wealth creation from debt instrument like bond to equity, stocks, derivatives, and hybrid securities. Each type offer unique benefits and risks tolerated to investor need by facilitating liquidity, diversification, and income. Securities drive economic growth while requiring careful risk evaluation, understanding their features, market dynamics, and regulatory oversight, empowering investors and businesses to make informed discussion, fostering stability and innovation in a global finance. This is the conclusion. Thank you very much.